Just a reminder, nothing I share here is financial advice. This is all based on my own experience, my strategy, and how I see the market. You're responsible for your own trades, so always do your own research, manage your risk, and never trade money you can't afford to lose. This content is meant to help you learn and think for yourself, not to copy or follow blindly. Let's keep it educational and intentional. Good morning, guys. Let's go straight to the chart. January has now come to an end, so let's have a look at the monthly statistics. Before that, we need to zoom out to the yearly time frame. On the yearly chart, we were watching a few key levels. First of all, the previous year's range, with the 50% to the downside and the 50% to the upside. Historically, we usually see both sides getting filled at some point, at least on lower timeframes. Price has now moved down into the lower 50% area and even broke slightly below it. Currently, price is sitting just above the previous year's low. This is, of course, a very important level. It is now a local SFP level within a local range. Since this is a yearly candle, an SFP here can still give a reaction, but we also have a lot of stops below this level, so a deeper wick is definitely possible. We also have an SR level visible on the lower time frames, but you can clearly see it on the yearly chart as well. This level is basically the top of the previous highs. We had a break above it, and now price is coming back down to retest that level. On a yearly candle, this process takes time, but that's exactly what we are seeing right now. Another important observation is that the previous downtrend showed a very similar structure. A breakout above the previous year's highs, followed by a retest and then continuation. We see this type of behavior on lower time frames almost every day, and as mentioned, on the yearly time frame, it just takes much longer to play out. With that said, I have marked a level here that technically comes from a lower time frame, but it aligns perfectly with the previous yearly high, which makes it a strong and valid level. Now, another scenario we need to consider is that price could move a bit deeper into this area. It doesn't have to happen, but if the previous year's low does not hold, meaning we don't just get a clean SFP and hold above it, then the door opens for lower prices. In that case, the next target would be around 64K. Again, this does not have to happen, but from a candle SFP perspective, this is a valid scenario. The idea is simple. When a candle gets SFP'd and the setup is bearish, we usually aim at least for the midpoint of the candle that got SFP'd. In our case, that midpoint sits slightly below the SR level, basically around 64K, give or take. So what this tells us is that price is approaching a very important level. Yes, there are other levels as well, but when price interacts with a yearly candle, the lower time frames start to carry a bit less weight. This is a key area where we could see an SFP into the level, but for this specific candle-based setup, the typical target remains around the mid-candle level, and we can then refine and track that on the lower time frames. Here on the lower time frames, we can see that we are trading inside the monthly range. That means we have a clear swing low and a swing high, which defines a structure range. What does that mean for market structure? Basically, it tells us that we are still in an uptrend, and within that uptrend, price is ranging from low to high, or vice versa. As long as this structure is intact, we generally look for a higher low. In the worst-case scenario, we would expect an SFP of the low. Logically, because a clean close below this level would be a structure break. So when price comes into this level and taps it, what we need for a bullish reaction is a monthly close above this level. The candle can wick lower, that's fine, but the key point is that the monthly candle must close above it. Otherwise, we get a monthly structure break, which would mean acceptance into the next lower area. If that happens, then the next higher time frame support level comes into play. That would be our 4-day order block, which aligns with the highest part of the SR level. Inside this area, we also have a point of control. This is a 2-year point of control, meaning it includes all the price action from the move starting in early February 2024 up until now, February 2026. This POC sits roughly around 67.4K to 67.2K. It's an area, of course, because we are dealing with a higher time frame level. With that said, this month will be very important. It will decide whether we continue ranging here, potentially get an SFP and bounce, or whether we see a breakdown to the downside. As mentioned, the monthly candle can wick all the way down. This doesn't have to happen, but it can, and still close back inside the range. That would be painful to watch, but it would still be considered a bullish reaction until we get a confirmed close below the level. So far, one side of the yearly wick has almost been fully filled, and the low is still intact. We'll come back to the downside scenario if we actually get a move below. Until then, it's all about preparation in case price goes lower. By the way, if this level SFPs the yearly candle, then statistically it becomes very low probability to hit the opposite side within the same year. This hasn't happened yet, but I'm just sharing the statistics. You can check this yourself by looking at yearly candles. You'll see that we've basically never seen that on this time frame. Another thing I showed in the text updates is related to January candles. If we look at all historical Januaries, we can see that only twice did January not form, more or less, the high or the low of the year. With that said, the January candle is already in place and price has already taken out the January low. That alone makes it a low probability scenario to also take out the previous month's high within the same candle, meaning within this month. In other words, the yearly high is likely already set and we don't expect a move or a break above January's high. Small disclaimer here, low probability events do happen. We saw that last year a few times, mainly around the January candle. But most of the time, I stick with higher probability scenarios because over time, they tend to perform better. Just as one example, at the top, we had an SFP of the high, and price came very close to the low, but didn't sweep it. Only in the next month did we take out the low, and from there, we didn't make a new high until at least the following month, which is exactly what we then saw. On the most recent candle, we actually took out both the low and the high, which is a low probability event. But again, most of the time, these small statistics are useful and at least help me with decision making. All I can do is adjust the statistics over time and keep doing what I've been doing before. With that said, the updated number is no longer around 65%, but closer to 93% of cases where we do not see both the low and the high taken out. In roughly 7% of cases, we do see that. Of course, these stats will change over time as more data comes in, including both successful periods and low probability events. So what do we have now when we combine the yearly chart with these lower timeframe levels? Price is currently at the lower part of the range, which is a major support. It's also the yearly candle low. Below that, we have previous highs, volume sitting inside this area Tholis, and the 50% retracement around the same zone. This is a higher timeframe area where, ideally, we do not want to see higher timeframe candles closing below. Otherwise, we would find acceptance back into the lower range, and from there, we could start looking for even lower levels. For now, I don't think that scenario makes much sense, but we will come back to it if price actually moves lower. As it stands right now, this is a very important area, and we need to see how price reacts here. Based on these two views, the probability of going above the range high in the near term is relatively low. I'm not betting money on that scenario. Yes, it looks like I missed my short, but that's fine. I'll simply observe what kind of reaction we get here, whether the high holds or whether we take it out in a low probability event. I'm just sharing the numbers. You can judge them for yourself. With that said, let's switch to the monthly statistics. First, let's look at the January stats level. Here we can see that price initially hit the upper monthly median wick for a bearish month, and then moved down sharply, way below the bullish wick level. It also moved outside the average time window for both an uptrend and a downtrend. Normally, when a high or low forms within the average time window, you want to see that level hold. Since price had moved higher and already taken out the previous month's high, my expectation, based on the statistics I showed earlier, was that it would be a low probability scenario to also take out the monthly low. Because of that, I was looking for a higher low to form and for upside continuation within the range. However, as we can see now, the low probability event played out. Price made a new monthly low, and it did so outside the average time window. With that, we got a deeper move exactly into the bearish monthly stats level, mainly the median level where price typically closes on a bearish month. And that is exactly what we saw here. So even though my expectation for continuation higher from this range was wrong, price still respected the monthly statistical levels perfectly. Now, with that context in mind, we can move on and look at the new levels. Okay, so now let's look at what we have here in February. February is statistically one of the most bullish months of the year. Around 73% of the time, it closes positive. Given the fact that we already had 4 consecutive negative monthly closes, a positive monthly close is statistically around the corner. And yes, that positive month could very well be February. That doesn't mean it has to close positive, but if support is holding, then this statistic does carry some weight, and at the very least, you would expect a bounce. Based on the averages, we can see that months which close negative usually have their price levels roughly between 67K and 64K. If we go back to our previous chart, we can see that this aligns very nicely with our SR level, the point of control, and the 50% of the yearly candle. So a move down into that area is definitely possible based on the average monthly moves. The difference to previous months is that back then, there were more or less no clear target zones because the averages didn't align well. This time they do. So now I can clearly say, yes, a move down into that area is possible. And because this is a higher time frame support level, if price gets there, I would be priced there. I would be interested in looking for trades. What we could see there is either an SFP or a deviation, meaning price trades below the level, ranges a bit underneath, and then moves back inside. So for now, we know that this downside move is possible. On the other side, for bearish months, the average wick to the upside is around 84K. That means in bearish months, we often see a move up into that area, sometimes more, sometimes less. And that's typically where you want to see weakness and rejection, followed by a move back down and a break below the low. That would define a bearish month. For bullish months, the average wick is roughly in the 5 to 8% range. That means the month usually forms the low first and then moves higher to close positive. However, price can also hit both sides and close somewhere in the middle, like we saw 1 month ago. So with that said, if price does not immediately break down or break up, the local range becomes important. We then look at where the average wick levels act as support. These levels align with the local lows. The first one was already hit today, the median for bullish wicks. The average bullish wick would basically mean an SFP of the monthly and yearly low. If that happens and we see a reaction, then we look for a bounce. If we do bounce, the average and median targets would be around 94K, with the upper average around 99K. What's important to keep in mind is that there is still a lower probability of taking out the high. So if we get a move up, I will be watching for weakness and potentially hedge longs. If a low probability event plays out and price takes out the high within the same month, then we reassess. Keep in mind, the median was already touched. It's still early in the month, and price is still inside the time windows. So the low or the high can still be in the process of forming. Now let's talk about timing. On average, monthly lows form around the first week, roughly day 8, and more into the second part of the month during downtrends. The same goes for monthly highs. They also tend to form more in the first part of the month. Today is only day 2. So yes, this could already be the low. And if that's the case, we would look for a rise, then track the average time window and see where price stands. If price rises, hits the average wick levels, and does so within the average time window, then the high is most likely in, unless we get another move outside the time window, similar to what we just saw to the downside. The same logic applies in reverse. If we see a rise first and then weakness, and price starts to move lower outside the average time window, that would suggest that lower prices are possible. Right now, price is sitting at a support level and has slightly front-run the monthly swing low. As long as we don't see a strong bounce, the low can still be in progress within this time window. It could still be swept later or appear later in a bearish scenario. In a bullish scenario, the low would form now or within this time window, followed by a move up without strong rejection. Now let's look at resistance. The average bearish wick sits around 84K. That level is more or less the lower part of the previous range that was recently broken down. That makes it resistance. If we switch to the CME chart, we can also see a CME gap around the same area. The gap itself ends around 81K, but the Friday close was at 84K, so we have resistance confluence there. That means if we see a move up, this area is very important to watch for signs of weakness or strength. If price moves above this area and finds acceptance back inside the previous range, then the structure is no longer the same as in the previous bear market. In that case, I would also start aiming for the monthly median and potentially a new high. But I would still treat that as a low probability scenario based on the candle statistics. So to summarize, we now have the monthly levels. Price is sitting near a major level and a structure swing point. We know a move lower is possible, and we have clear downside levels based on average moves. We also broke down from the previous range, so any move up is technically a retest of that range, and only a reclaim would be bullish. Based on candle statistics, it is currently a low probability event to take out the previous month's high within February. I will track that and use it as confluence, and if it fails, I'll adjust. With that said, let's now move on and take a look at some local levels and momentum. Okay, now the chart gets a bit messy, but everything should be clear in terms of what to look for and where the levels align. On the daily and weekly charts, price has made a new low, which shifts both the daily and weekly swing lows significantly lower. Previously, both swing points were much higher. The daily was up near the highs, and the weekly was around the all-time high. Now that we've made a new low, we also have a new main structure swing high to work with. Starting with the daily, price is now basically trading inside this new range. The first key high, which I already showed before, is the level where I said that if price starts to find acceptance back inside the range and reclaims that level, then I would aim for the next resistance. Until that happens, this area is simply a lower high zone, where price would typically form a daily lower high at resistance, or potentially an SFP of the high. Same logic as always. A clean break above that level would be a bullish daily structure break. If price instead forms a range here and then makes another new low, the whole structure shifts lower again, and we repeat the same process until price eventually breaks above a swing high. Now looking at the weekly swing low is also sitting here now. This is basically the last major rejection point we had. From a weekly perspective, price is still below a lower high area. If we see a break above it, that would be a bullish weekly break, and we would then look for higher prices, similar to how previous bullish weekly breaks played out. Right now, these levels are aligning quite nicely with the monthly median and average move, which means a bullish move into this area is possible based on averages alone. If we zoom into the lower timeframes, the 1 hour and 4 hour are clearly in a downtrend. As long as price does not make a new low, that remains unchanged. The current 4-hour structure aligns well with the monthly average upside wick, which adds confluence to that first resistance zone. If price makes a new low, then these levels shift lower again, and I'll redraw them when that happens. As for positioning, I closed my leverage trades from this range. We had a few nice wins while price was ranging, but also a few losses toward the end. Since my plan for an upside continuation from this range was invalidated, I closed those positions. Now I'm waiting for more data instead of forcing a new trade. I feel zero FOMO and no fear. I'm not in a rush. I just want a clean setup, and I'm perfectly fine waiting for it. If price moves higher first and then gives me a retest, that's totally fine. But without strength and without a clear range reclaim, I don't want to jump into longs immediately. I'm still holding my spot positions, where I've been averaging down, so there's no pressure to catch a move. I'm simply waiting before opening the next leverage trade, and I'll keep you updated when that happens. For today's averages, we can see that price already hit the average loss level and bounced. The average gain level is slightly above current price action and aligns with the 1-hour swing high. That makes it the first daily resistance if price moves up. The monthly open and weekly open are also roughly in the same area. If, over the next few days, price reclaims that zone, then we could start looking for a setup toward the next resistance level. Until then, I'm waiting. So that's basically it for the stats and local levels. You now know the key monthly statistical levels, the current market structure swing highs, where resistance is on a first push up, what to watch for on the lows, SFP versus acceptance lower. If we see a first rise, we look for resistance and rejection. If that fails, we look higher. On the downside, we look for SFPs, and in a more bearish scenario, a move toward the next confluence levels. Keep in mind, we already closed 4 consecutive negative months, and February is statistically the most positive month in terms of closes. Because of that, I remain in my spot longs. The rabbit box has now filled the next order, and the target remains around 95K. I'm holding that spot position until the target is hit. Of course, it wouldn't be nice to wait a full year for that, but that scenario is not confirmed at all right now, especially since we're still sitting in a higher time frame support area. The next bounce, or lack of it, will tell us what to do next. Until then, I'm simply waiting. What I also wanted to show you next is a new indicator from Crown. By the way, if you want to use my statistics for the day or check out other tools, you can visit Crown's page. The link is in the description. You can also use the White Rabbit code to get a 20% discount on everything they offer. Anyway, let's get back to the indicator itself. This indicator is designed to look for volatility expansion, trend exhaustion, and related conditions, which you can configure in different ways. In the end, it highlights extremes, depending on how you set it up. In my case, it's more focused on downtrends and potential bottoms. What that means is, when a downtrend is in progress and multiple conditions start to align, the indicator begins to print strong signals. Keep in mind, my settings are not fully optimized yet. However, the latest signals are basically the same as the ones shown on Crown's own chart, which tells me my configuration is already very close. I just need to fine-tune a few extra parameters. This indicator looks for bottoming behavior. When a bottom starts to form, or when the conditions for a bottom are met, we see these signals, usually near the lows and often during the final leg of a move down. Right now, we are seeing this signal flash on the candle that broke down. So yes, the move itself was bearish because the conditions were met, but at the same time, we can already see that we are entering a bottoming process. Of course, deviations can still happen. I think the model allows for something like a 20% deviation. If we take 20% in from the close, that would put price somewhere around 61K. Again, this aligns quite well with the monthly statistics, where we also had room for roughly a 1% to slightly deeper move down. So if that happens, there are statistical reasons for it. But the main point here is not the exact number. It's that this type of signal usually marks the start of a macro bottoming phase. It doesn't mean price has to go that deep, but I'm sharing the levels and data based on the analysis. What I really want to point out is this. This high does not look like a typical Bitcoin macro top. A lot of things are not signaling a major top. From my perspective, I followed my plan, and I'll do the same next time, whether the trade ends up being a win or a loss. One thing is clear, though. If bottom signals are already starting to appear, then the bottom is most likely not at levels people like to throw around, such as back to 20K. Based on everything I see right now, the bottom is not far away, and we are actually closer to a bottom than to a top. I know not everyone will understand or agree with that, and that's fine. Over a longer period of time, it usually becomes clearer. Even if price moves lower, I do not think this is a classic bear market like we've seen in the past. We already had a yearly negative phase and a downtrend, and now people are calling for a new bear market, while at the same time, we see signals like these popping up on higher timeframes. That doesn't mean price can't go lower, but for me, it does not mean the top is in and a standard bear market has started. So to wrap everything up for today, statistically, it's still a low probability event to take out the January high. We know low probability events can happen, but I stick with the higher probability scenarios. We are sitting at a higher time frame monthly structure swing low. A retest of the previous range is possible based on monthly averages. February is statistically the most bullish month, and after 4 red months, this could be the positive one. If we get a rise, we look at the average levels and structure swing points. If price comes back inside the range, we look to trade the range higher. If not, it's a rejection. I've closed all leverage trades, only the YOLO box remains. All spot trades stay open because I have no invalidation on them. If we get a rise and then weakness, I'll look to hedge. Based on my statistics, I had no top confirmation, and now we are seeing early macro bullish signals. A move down is still possible, but these signals usually appear during the last phase of a downside move. So for now, I'm waiting. I'm not aggressively bullish because we broke down from the range, but I'm also not overly bearish because we are in a higher time frame support area and signals are starting to appear. That's it for today. I hope this was helpful or informative. Have a great day, and I'll see you in the next one.